Good morning, everybody. Welcome to the Flow Show, Wednesday, 2nd October. Lots of bad things happening in the world at the moment. Let's talk about things for markets to get stuck into as well, which we'll go over. We've also got another guest on today, joined by my teammate, my colleague, Grega Horvat. He's going to be coming in and looking at some wave analysis for some assets. So looking forward to him dropping by. In the meantime, don't forget our sales on last few days. We have extended it just to cover across the end of the month into the new month. Some people are asking if they can just wait till payday before they can join the program and take advantage of those good sale prices. So just the last few days for the sale on that, and then when it's gone, it's gone. And there's no to take the words from central banks, there's no preset course for our sales. So this might be the last one. Who knows? So always a good time to grab a good price. Right, let's get on with it. See what's going on in the world. We've had a bit of talk out of Japan. PM Ishiba continuing to make his views heard. He says that Japan is on the cusp of making an exit from deflation. This is a big drive that the new PM wants to finally get or be able to claim that Japan is out of deflation. This is their big push at the moment. So that's the focus of the new government going in. Obviously, we're going to go to elections as well at the end of the month, which is likely a foregone conclusion, considering that the LDP is the biggest party, relatively unchallenged. So again, that's just to cement Ishiba's PMship. He also said that they're going to consider delivering payouts to low-income households hit by rising living costs. So that's keeping the fiscal pedal down. They said they will carry over and steadily push through the growth strategy of former PM Kishida to achieve growth driven by higher wages and investment. Says we will pursue fiscal policy that puts the highest priority on ending deflation. Hopes the BOJ maintains easy monetary policy as a trend. Won't comment on specific rate policy, which is up to the BOJ to decide, but is watching its decisions carefully. Now, this is just my viewpoint. It does seem that they are being a bit more cautionary on the Bank of Japan than they were previously, or Kishida was previously. That's backed up a bit as well by the economy minister, or the Minister for Economic Revitalisation, as he's called, Akazawa, saying it's not necessary. Who said it's not necessarily correct that Ishiba is positive about further interest rate hikes. But if we read between the lines, it seems like Ishiba wants to make sure that whatever the BOJ do, it's taken in mind that they go slowly and cautiously and look at the risks and judge everything like that. Finance Minister Kato said that they hope the BOJ will take appropriate policy action to achieve 2% inflation target while taking into account financial situations. Now, Ueda was up talking today. He had some comments early in Asia saying that markets remain unstable. The rest was pretty much the same old waffle. Then he did meet Ishiba this morning about an hour ago, 30 minutes ago, an hour ago, which the market decided it was going to put a lot of focus on, forgetting that the government and the BOJ have regular meetings to talk about the economy and whatever. So we met Ishiba and said that we will adjust monetary easing if our outlook is realised, which is their plan all along. He said, but they will take time and careful steps to achieve that. So they are mirroring what Ishiba's caution in terms of continuing to raise rates, which we knew about already. So really, there's no real change from the government. There's no real change from the Bank of Japan. No one's upset anyone else. There's no big policy changes. It seems business as usual, but the market still seems it wants to jump around every time there's something said. Anyway, Over in New Zealand, it seems that this 50 basis point rate cut theme is the fashion now, because HSBC now expect the RBNZ will cut their rates by 50 basis points October 9th, their meeting. ASB Bank also now expects a 50 pip cut in October, and they also expect another 50 pip cut in November. I don't know why the market is getting all balled up for 50 basis point cuts. It's not like we're seeing deep contractions and economies falling off a cliff. But you know, we said it when Powell and the Fed did their 50. He's opened up a can of worms. Now the market's going to want 50s all over the place. So that's the theme. The RBNZ, we'll have to have a look, see what the expectations are going into that meeting. I haven't checked yet because it's not till next week, so plenty of time to look at that. And then we'll see whether a 50 BP cut is justified or not. Over at the SMB, new bod Schlegel says downward risks for inflation are higher than upward risks. We will ease our monetary policy if necessary. And then this line got dropped in, which I found pretty amazing, that they cannot exclude negative rates. Here we are already talking about negative rates. Though it did counter that they cannot rule out any measures, but nobody likes negative interest rates. Over in Germany, we had the one of the associations there, the VDMA, said that engineering orders rose 7% in August year on year. So potentially some good news for Germany on the manufacturing front. Domestic orders, though, were down 7%, and it was export orders that did the heavy lifting there, up 13%. So at least seeing some export numbers there for Germany. Over in France, we're back to the old theme of kicking targets, EU targets, down the road. New French PM Barnier says he's delaying France's 3% deficit goal by 2 years to 2029. Now that is a rule by the EU that states need to come in at or under 3% for their deficit, and if they don't, they face the severe consequence of getting a sternly worded written letter saying, why haven't you done what you should be? Anyway, can's been kicked. He also plans to raise taxes on large companies and an exceptional tax for the most wealthy, which won't go down very well over there. There's a lot of fuss being made in the UK about how people are rich, millionaires and the like are leaving the UK because of the heavy tax burden that might be coming in from Chancellor Reeves. Well, France is doing exactly the same. So I don't think people are going to be jumping out of the UK and landing in Paris anytime soon. One of the ECB hawks, Kazakhs, says he very much agrees with market pricing on an October rate decision. So seems he's going to be voting for a cut. He says recent data does point to an October cut, but counters that by saying markets shouldn't get ahead of themselves on rate bets. So probably an indication not to start thinking about 50s and a fast set of rate cuts. But it looks like he's on board with an October cut as well, looking like a done deal now. ECB's De Guindos says the risks to growth are still tilted to the downside. As for expectations for the ECB October meeting, Citi expects a cut in rates October, December and through the start of 2025 to reach a deposit rate of 1.5% by September 2025, which looks a little low in terms of where the neutral rate probably is for the ECB. Probably, I would say, seeing as ECB is at rates much lower than everyone else, maybe looking around the 2%, 2.5% mark. 1.5 might be a little low, but we'll have to wait and see where the economy is at by then. UBS also expects a 25 pip cut in October and then cuts in December, January and March. Give me 1 second because I'm just trying to get Grega in the room so I know he's here. I have Grega, ping me on Skype if there's a problem. I have tried promoting you a couple of times. Right, okay. Yep, there he is. Cool beans. Right, I shall crack on, and then I'll bring Grega in a moment. Bit of data to look at yesterday, PMI data. We had first Canada out, and a bit of a surprise jump in their manufacturing PMI went into expansion, 50.4. Whoopee for the old syrup swiggers over there. The S&P manufacturing PMI in the US, the flash number improved by 3 pips to 47.3, but was still lower than last month. The ISM, bit of a shocker. The headline number came in unchanged over last month, was expected to rise, but we saw some big moves, particularly in prices that went quite significantly into contraction. Such a big move from 54 into 48 might be just some sort of skew in there, maybe some one-off factors. I don't know. We'll see next month, but that's a pretty big move. Employment also went further backwards. This is one area, manufacturing has been one area where there has been job losses, but it still remains a significant but smaller sector than the services sector. So we're talking about whether there's low hiring or firing. There's been a bit of firing in manufacturing for a while, so there's no change there, but it's getting a bit worse. Reading the comments in the ISM report, it did sound a bit more bearish from the respondents than it did last month. A few more citing worries, citing the election, just saying that orders, expectations are a little bit weaker than they were last month. So still manufacturing in a bit of a slump. And then par for the course, we got jolts, which instead of going down, went up a huge chunk. We got a big move down last month, and we got a big move up this month. So once again, you think the arse is falling out of something, the data point, you think it's turning weaker, and then it comes roaring back again with a higher print. So another low one would have played into the weaker jobs market, would have got those expectations probably running again to the 50 pip side, but that bounce in jolts has waylaid that. Over in what am I looking at now? Yeah, speaking of jobs, Samsung is apparently planning thousands of job cuts as part of worldwide layoffs. So that's potentially a significant bit of news there. We know that the tech sector, particularly in the early part of this year, was cutting quite a few jobs, and it seems there's more to come as well. I think, have we got it today or is it tomorrow? Challenger layoffs. We'll need to keep an eye on that one. It's tomorrow. That's a report that I keep half an eye on because it shows numbers like that popping up when people announce layoffs. So we need to see if that's picking up steam as well generally. OPEC's got its meeting today, OPEC Plus, and they're unlikely to change their output policy according to sources, but probably the market's looking at what's going to happen in the latter part of the year, their big OPEC meeting, rather than keeping things unchanged right now. Obviously, we've got this Iran-Israel thing going on, so everyone knows what's going on now. Iran lobbed over 200 plus missiles into Israel yesterday evening, overnight. It was said that a lot of those got intercepted and whatever, but if you're looking at various news sources, it looks like a lot got through, maybe more than what happened in April. It seems like it was a bit of a restrained attack, as one can call it, because the targets were mainly military and security installations rather than, heavily populated areas and the like. So this is following a similar pattern to the attack that happened back in April. It is different. I think there is a bigger escalation this time around. But if you take it, what's happened, Israel, they've been steaming into Lebanon and taking out Hezbollah and various targets and whatever. Iran has retaliated, much the same as happened in April. This time, though, Israel has said that they will issue a big response to that. So it's a bit difficult to put it in a sporting analogy, but the ball is in Israel's court now as to whether they do respond, and then Iran responds again, and it escalates and escalates. They have said that Israel has said that the response this time will be different, and that they will launch a significant retaliation within days that could target oil production facilities inside Iran. And there are some sources saying that they may target nuclear facilities as well, which would be, again, a bit of escalation and not a good move for them. So really, Israel's done their bit. Iran's retaliated. Either they're going to call it even, or Israel's going to retaliate, and then we probably are going to see things stepping up. So we've seen a little bit of risk off washing out this morning, but we're not going to be, the market's not going to go back to completely ignoring this. It also still presents risk for the next few days, over weekends and stuff. So be wary of things like that, particularly in the usual risk assets, gold, oil, and everything currency related to those as well. What we do know from yesterday is that the dollar finds a bid on all this risk stuff. So that's becoming the safe haven play for risk off. Also the yen as well. Yesterday we saw quite significant running into yen and Swiss. Gold ramping higher as well. So the usual risk safe haven assets are seeing action there. So bear that in mind if you're trading those. It can only take one headline to throw those around a bit. Right, that's it on the headline front. So I'm going to have a quick look, a couple of things, then I'll bring our man Grega into things. So I'm going to start with oil. So here's the risk premium coming into oil again. I mean, it's okay. $5 is a decent move, but not if we're really heading towards a bigger conflict. Really, the oil trade is only going to become something if the other Middle Eastern states get involved, if it becomes a bit contagious, and it's going to kick off in a big way. But Israel retaliating, that will likely ramp up, as I said, risk assets like oil, because that will force Iran to retaliate again, and then the targets may not be just military and security installations. They might step it up and make it something worse. So we are still walking a fine line here. If that happens, we're probably going to be $80 in oil pretty quickly. That's US oil. Obviously, Brent is more geographically located to the conflict there. So again, we'll probably be well up into the 80s if it does kick off there. So just take care of that. Also, watch your commodity currencies like the Canadian dollar. It was, if you're matching it off against, if you're playing the correlation between oil and dollar CAD in particular, know that it's potentially a different kettle of fish. Because the US dollar is going to become the risk-off currency, you could find higher oil and higher dollar CAD as opposed to strengthening CAD on the oil side of things. So just know if we're getting risk moves, what's driving the bus, because it may adversely affect some pairs that you would follow usual correlations for. Dollar yen, that's back up into the 144s. It's still looking pretty positive. The market's still looking like it's a dip buyer on this after that bounce from the 139s. I'm still looking to play this from the dip side. I got trailed out of my longs yesterday at 143.20. I haven't got back in. I'm just letting it do its thing for now. Same old levels up here. This 25-30 area, we're just mooching around at the moment. The bigger level up into that 144, 50, 60 area around that fib. Although we had this move above 145, this was all over the PM race. When we had that move up into 146, I should think 145 is going to be a bit more solid this time around. So if we do get above here, look at that 145 area. I still think we're potentially looking at a range potentially with a top around 147 if we're following things like yields and the like, which are ticking up a bit, seeing a bit of risk off washing out of this. Twos just back on the creep higher. Tens recovering, test of 370, decent hold there, and we're seeing a bit of a bounce now. Obviously that's helping dollar yen as well. So yeah, it's really a fun time at the moment. You've got to look at what's driving what. You know, a lot of people looking at oil rallying and wondering why dollar knock was going higher instead of not gaining on the oil move. Well, it's gaining on the dollar risk side. So that's why this one's moving up. I'm still keeping half an eye on this one. It's still stuck between 1065s and 1045s, 1039s. So not doing too much, but this is waffling around with all these risk moves too. Right, Grega, you're on, mate. Do you want to? Good morning to you, first and foremost.
Hey, good morning,
How
man.
right?
How are you?
Yeah, I'm good, mate. I'm good. Keeping your head above water with all these moves at the moment.
Yeah.
That's good to hear. That's good to hear. Do you want me to bounce you over the screen?
Yeah. Just I put my phone on mute. Just a second.
No worries, mate. All yours. Let's see what you got for us today.
Okay. Can you see the screen? Yes.
Yeah, all good, mate.
Okay. So last week when we discussed, as you know, we've been talking about, I was talking about potential dollar support down there. We identified this ending diagonal known as a reversal pattern. So it told me that this kind of a price action told me that we are in late stages of this drop and that bears are not that strong anymore. So sooner or later, I was expecting a rally, and this rally was in my view because there was some divergence between US yields and the US dollar at the time. And you can see that the US yields are recovering nicely, and I still think that there is a room for much more upside here within this corrective wave for rally, maybe even close to 3.9 or 4% on the 10-year. So I think that the dollar could also stay sideways or correct even higher. So I'm sticking with the targets around to 101.90 to 102, which will once again be very important resistance, especially because if you look at the higher time frame, we are still going to meet this trend line up there if we retest these levels. So for now, I think that we are still in the period of consolidation. There can be room for some more dollar trades on the upside here, especially because if we really completed this ending diagonal and bottom temporary here, I think that we should see minimum 3 waves up. So after dips, I think that there can be some opportunities on some of the pairs, especially if you will maybe look at some of the very weak pairs or currencies, sorry, like euro, for example. Keep in mind that the euro dollar, one of the reasons why we have seen a very strong decline was because yields in Germany were falling much faster compared to one in the US. So this rate differential obviously makes the euro dollar quite bearish here, and I think we could see another touch of very important level here at 1.10. So for now, I'm leaning more towards dollar bullish side. And of course, if you want to be maybe set on the long side of the dollar, maybe you should look for some weak currencies. Like today we can see euro, pound. These are all looking very weak. Of course, commodity currencies are holding up quite well. Aussie is actually just moving sideways, and what it's also very interesting maybe is Mexican peso. Now, keep in mind that crude oil has obviously seen a very nice bounce to the upside. And as you can see, when the price action was quite stable here around or above $70, we were seeing immediate reversal on Mexican peso. Okay, so that's actually at the bottom. We have Mexican peso versus US dollar or dollar Mexican inverse chart. So we can see that this currency is now trying to stabilize here. And what's important is that I think that crude oil actually has room for 73, 74. Maybe we can firstly, again, retest. Ideal support would be at $70. But then I think that Mexican peso could see more upside. But I would not be looking maybe for some trades on dollar Mexican peso, but I would rather look at then at very weak euro dollar, as we just discussed earlier, versus Mexican peso. And we can see some very nice Elliott wave pattern here as well. We have potential top formation here, because in Elliott wave terms, the top can be confirmed whenever you have a drop away from that highs in 5 waves. And that's clearly has been the case, okay? It's not some overlapping or slow price action. It was quite strong reversal, and that's called an impulse. But this rise was quite deep, but still it stopped around 22, and it's around the 61.8% at the upper side of this flag pattern. And now we are trying to break the lower side. So I think that there is room for more weakness here based on all combinations of weak euro, or maybe I could also say recovery on the US dollar and recovery on crude oil at the same time. So I'm looking here for more weakness. And also what I would pay attention on in the next few days, the rest of the week, if we really think that we are here once again in the US yields in this corrective wave 4 rally, then maybe even gold is now ready to make some pause. And we can see sideways price action. However, I'm very bullish on gold, no doubt about that. But I think that there is still a chance maybe to retest, firstly, slightly better supports around 2,600. So I will be looking for potential longs in that area. It could be a very deep, very beautiful fourth wave retracement here. So what I'm looking at here and how I'm identifying levels, I am comparing this correction to the current one. Okay, so basically that's the correction of the same Elliott wave degree here, and I'm looking for possible retracement to the 38.2%. This comes in, as I said, around 2,600, and I think that this potential support is very important because it also dates back to September 18 when Fed announced a rate cut. So I think that that's a pretty nice, interesting support for next bounce. Of course, if we get to this level, maybe, who knows, we will see a straight push to the upside. But overall, that's the area I would focus on if we see some more weakness in the short term. Of course, my stops in such case, how I try to play fourth wave here, well, I put usually, or my stop somewhere around the 61.8% beyond, slightly beyond that level of extended wave 3. So if we think we are in wave 4, then 38.2% is the ideal support. But of course, sometimes you will see that this one will be passed. But to make the count valid, I certainly do not want to see wave 4 moving all the way back to the 61.8% of wave 3, because otherwise this wave 4 would not be fit good to this ongoing trend that we are tracking. So here below 2,555 would possibly be my stop loss. Of course, ideal zone would be invalidation level at the wave 1. But of course, I have to somehow keep risk reward perspective here in focus, rather than just blindly focus on and trade something on the long side and have a very big stops, because that would not make sense here. So gold, I'm expecting more upside, as said, after pullback. Euro dollar is in a corrective phase. I'm thinking about more weakness there, and with crude oil turning to the upside, I think that Mexican peso versus euro can do well. Also looking maybe at those stock major indexes here, we have seen another strong push to the upside on Hang Seng Index, but notice that other markets are now somehow turned into this consolidation, right? So maybe that's one of the reasons why gold is doing quite well compared to some of the currencies there. But overall, I just think that maybe if there will be some deeper correction on S&P 500, on DAX, and others, I just think that maybe it's worth to keep an eye on some yen crosses. Here we have euro yen. Again, I'm bringing on euro because euro versus yen, because euro is quite weak. So here we stopped at the upper side of this potential range here of resistance around 64, very close to 64. It was also this swing high break from November of 2023, so almost a year back. And we could also be making here right shoulder pattern. Okay, so I'm thinking that we could see in risk-off flows, we could see much more weakness on those yen pairs. Of course, there are some of them can correct even higher, especially like dollar yen, if dollar will try to be like some kind of a safe haven. So maybe even dollar yen, who knows, will stay sideways. But overall, in risk-off mode, I will look at these yen crosses that most likely could continue even lower, like it happened here through most of July, and then, as you know, we bottomed at the start of August, and back then we have seen a serious risk-off flows when Japanese yen was rallying. So I would be expecting some similar pattern once we are going to see wave C to the downside here. So basically, that's it. What I had in mind for and in focus for today. If anyone has any questions, please let me know. Ryan.
Yeah, please do. Please throw any questions up. Greg, I wanted to ask you, what are you making of this risk situation, and how do you apply things like this when you're looking at technical analysis? Do you still stick to the techs as strongly, or do you think you're going to get moves that are going to ignore the techs some of the time?
Well, I'm mostly, even if something unexpectedly happens and I see some of the fundamentals, macro stuff, whatever, to reverse the trends, I will most likely try to, rather than trying to push my wave counts and technical analysis in the direction of my current bias, I will just have to make a step back, and I will most likely review the longer term charts. And as long as my longer term charts are still showing unchanged structure, I will try to stick with the trends and with the Elliott wave analysis. I just think that this kind of events, like we were seeing like yesterday, in the short term, they can cause a lot of mixed sentiment, a lot of frustration, maybe some panic. But after a few days, few weeks, we know that these kind of events are quickly forgotten. Markets get used to it, and we fall back into normal trends. So that's how I try to also to stick with my longer term views and not be confused by these short term events.
That's brilliant, mate, because that's something we constantly preaching on here and in the chat room. When you get these volatile events, you can sort of ignore the short-term tech levels because rockets don't give a monkeys about charts, and as we always say, you focus on the wider picture, the bigger time frames, the bigger levels, the ones where if a market gets pushed there, the fundamentals may push back against such a move. So Gregor's in the same boat as a lot of us traders. If there's short-term noise, look at the bigger picture and focus on that until things calm down. So great stuff as always, mate. Thank you very much for that.
Thank you
I'm just going to grab the screen back quickly. Just a couple I want to look at as well. Can you see that okay, guys?
Yes.
Yeah, thank you very much. So euro dollar, I got well, I'm in a bit of a sticky one at the moment. I did start adding back to my euro dollar longs, trying against this 111 area. What's pretty significant at the moment is we're struggling to get back above this 110.70. This was a level that we tried several times, or a few times, to get below. Couldn't quite get below on dips. So it was a bit of a line in the sand for me. No surprise to see 30 odd pip move lower. We pulled up just ahead of this old fib 38.2. It's been a bit of a level around here as well, which you can see going back a few weeks. 110.40, we bounced from there. All these levels that we've broken through, we found a bit of support. 110, we came through the bottom of the zone. 110.88 already straight afterwards. Let's put it on a short-term chart, might be easier. Pretty much straight after this breakthrough, we found it resistance. Then we broke under here, found it resistance, still finding it a bit of resistance. So all these levels have to be retaken again. So these are now your resistance points going back up. Get back above 111 and hold 111, then potentially that keeps the big 112 in the frame. If we stay below here, though, we're probably going to be heading lower, albeit keep an eye on the risk moves and whatnot going forward. Also for gold, not to step too much on Gregor's toes, I think we've got a bit of potential now where we might be seeing a bit more of a solid range develop. As you know, I throw my levels in, all short-term levels. They need to be confirmed. This 2650 is a bit washed out. I think it's not an overly strong level that I'm probably going to rely on. 2640 I'm going to keep in there because we did get a bit more action against it, but really it's looking for me like we're setting up, 26 2022 up to 26 70 73. The fact we bounced from here, this support, straight back to the high and couldn't really get through it, just cements this level for me. So that's why I've just turned these reds, because I think this is the range that we need to be watching now. So if we break either side of that, then it's probably going to bring a fresh bit of direction that way. Could be setting up for a similar thing that we had down here. You remember that big old range from the 2470s up to 2530s. So possible we're setting up that. The reason this is important, obviously, because if you're trying to find an area to short, you want that evidence, that price evidence. Same on the downside. If you're looking to buy a dip, you need to try and buy a dip where the price is going to find the strongest support. So still work in progress, but it's looking good to potentially set up a bit of a range for that one. Right, it's a bit of a quiet day today on the data front. All we've got is the NBA data, I think, coming up a bit later. Let me just double check, make sure. Where are we? Wednesday. Would help if I knew what day it was. So yeah, not a lot of data coming up. ADP obviously as well is looking for a bit of a bounce to 124k from 99. So that's our sort of NFP appetizer. We do have a couple of speakers popping up as well. Bank of England's Peel popping up a bit later too. So not a big data event, but I think we're going to be driven by a lot of risk headlines and what's going on with YouTube. Himashu, I don't know if the YouTube stream's working. I don't monitor that. I'll check with the guys in the back end to see what's going on with that. Right, we'll call that a day, I think. Guys and girls, have a good one. Thank you again, Grega, for coming on board and sharing all your wonderful waves. And have a great day, everyone, and we'll catch you all up tomorrow.
Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.